Going to delve into the fixed income space now. Mark Todd from FIIG Securities joins me now in Sydney. Great to have you on board today. Look, the market update, I suppose, that balanced super funds have returned some 6.5%. It's a bit of an improvement on what we'd seen over the average return of the past 5 years.
Yeah, there was a Fairfax report in the weekend press saying that the best they've returned is 6.5% over the 7 years, James. So the average was actually under 1%, was 0.92. So I think overall the feeling within the superannuation industry would be one that wasn't a great return, and they would be very cautious in trying to promote the benefit of a 6.5% return when you could look at assets like a Westpac or a Woolworths, Telstra. You're going to get those sort of assets, those fixed income assets, 6.25% return for a comparable period. It's very hard to justify the value add when simple credits like those credits are performing the same sort of return. Do
you expect the attraction, if you like, and the take-up of the likes of Woolworths and Origin hybrids to remain, strong? I
think the Woolworths was very strong. The issue with the Origin is at the moment it's been delayed for a week due to ASIC. It's a complex issue, but Origin has a trigger in it where if it gets a downgrade, a credit downgrading, the investor is expected to take an equity piece. This has been sold to retail investors, and ASIC has made the point that you can't sell on the basis of credit ratings to retail. And it's a consequence of the global financial crisis in that retail investors were sold high-rated assets that turned out to be not that well, shouldn't have been as rated as where they were and didn't perform. So you can't sell credit. It's a mistake that should have been picked up earlier, I would have thought.
Look, obviously there's a real defensive skew for investors at the moment, and we've seen different types of corporate bonds and so forth get a fair bit of attraction. I mean, is there a deep enough market at the moment to, I suppose, sate or, if you like, or quench the thirst for the amount of these sort of offerings?
Yeah, I think at the moment it's chicken and egg, but the corporate bond market is growing, and it's grown at a retail base for quite a lot. That we're seeing great movements in that, particularly down here we're seeing good volume. And so that becomes an attractive piece. If you're looking at some of the equity raisings that we're seeing in the press, it might make some sense for some of those mid-tier corporates to come to the bond market and look to issue directly to the investors, where they start to understand credit, simple credits. So if you're in a top 100 listed company, it might make some sense if you need $50 or $100 million to come into a bond market and issue to clients that have been over the last 3 to 5 years steadily buying more and more credit. So we'll turn over a lot of business this quarter. It's been very active in the bond market. So at the moment, we're meeting demand quite easily.
And would you expect that sort of demand to continue? Obviously, with all this global economic uncertainty at the moment, risk-weighted assets aren't exactly the flavour of the month. Yes, that's true, and I would offer the thought that it's unperforming assets that aren't the flavour of the month, and I think there's been a crystallisation around that idea that equity isn't giving you the result that you would have anticipated. So if we're seeing over the last 7 years, 6.5 that's the bell ringer, that's the number one. That's saying to me that the performance is the issue, not the re-rating of risk. It's around the performance. So if I buy a debt portfolio that gives me a 7% return and that I'm very comfortable in getting that 7%, versus buying the equity piece where I'm unsure of my return, I'd probably tend to put a percentage into the debt. I'm not saying we are asking our customers to put all their money into debt products. We just think balanced is not 70% equities, balance is more 70% debt. So we would offer that. And Mark, sorry, do you expect longer term for that sort of that portfolio composition to change and have a lasting effect, where we do see, as we do in places like the US and the European markets, more of a skew towards defensive sort of assets as opposed to those riskier ones? I mean, is that going to be one of the lasting impacts of what we've seen on markets now for the last couple of years?
Sure. I think we're looking at structural change. I don't think anyone would doubt that. I think we're in I'm not calling it the death throes, but it's more about that passion that the people in the equity piece have about this is a great story, you've got to believe. And ultimately, people are just not believing that the doors are being shut in a consistent manner. It is a combination of the lack of performance and also the ageing population. You're looking at some annuities that can give you nice, steady 7% returns, and people are looking to retire with good grace as opposed to getting up every day and looking at where the Dow has to lead, the ASX 200. That's not necessarily the retirement that people want to have.
All right, Mark, always good to talk. Thanks a lot.